Donald Trump is president-elect in the United States of America, and we want to talk about the consequences for the capital markets with Gregg Guerin from First Trust. Thank you for being here in Berlin.
Thank you.
What impact will the election of Donald Trump have on the markets? Where should investors look to invest?
Yeah, absolutely. Thank you for the opportunity to talk about it too. I think it's really important, just before I answer where I think it's important to make sure people remember that he's been president before. And so some of what I'm going to say just goes back to looking at the stock market from November 2016 till about 2020. Of course, making sure we evaluate the COVID period quite differently, and just kind of thinking what really happened when he was president before. I think it's a much bigger move when you take tariffs from zero to something than from something to something higher, because we hadn't seen them really before and they were threatened. And then what you saw in 2018 was in the end, an overreaction. We saw a very big correction in the capital markets at the end of 2018 after they passed the taxes at the end of 2017. So you had a great year in 2017, a correction in 2018, and then a rip-roaring 2019. And then I think we have to take 2020 and do something else with it, because it was much more about COVID. And when you look now, it's very clear that the most important impacts that Trump is going to have are basically three T's. So taxes, tariffs, and what we would call takeovers. Takeovers is a catch-all for just more capital markets activity. There's a huge pipeline for IPOs, M&A activity. The Biden administration and the Lina Khan FTC chair have been very much against a lot of M&A. You saw it took Microsoft almost a year just to buy a video game company, Activision Blizzard. And so now they're looking into Google. And we don't think that will necessarily change, but more the broad approach to letting M&A take root. So we think both looking at the smaller and mid-cap companies in the United States are going to have a better opportunity, both because of their valuation spreads, which I'm sure we'll talk about in a minute, the greater focus on the U.S. economy, and the opportunity for larger companies to get their more inorganic growth prospects from the more mid and small cap companies. On that, we think tax rates are likely to go slightly lower. So the personal tax rates are going to stay in place. The corporate tax rate might actually go lower. And now that the Republicans won the House and the Senate, it looks like that actually might happen. Maybe not all the way to from 21 to 15%, but maybe from 21 to 18%. And if you just think about who benefits on marginal tax moves, it's not Microsoft or Apple who can put their IP in Dublin or the Isle of Man. It's small companies in the middle of the United States. So that's another reason why we like smaller and mid-cap companies in particular. And then on the tariffs, we do think there will be some, but it'll be more partner-specific. So we're not going to see wholesale all of some particular product have their prices up. It'll be Chinese manufacturers of a particular thing. We think it's possible apparel might be the next area that might come under threat. And so that might have impacts on specific companies like a Nike or a Target or something like that. But in general, I think it's very important for investors to remember that while he likely will use tariffs or threaten tariffs or talk about tariffs all the time, we've seen them before. The market had a very short and truncated pullback from September of 2018 through the end of 2018. And in the end, that was an overreaction because earnings continued to grow from 2017 through 2018 through 2019, even through today. And as you saw that the tariffs were in place in 2021 and 2022 and 2023 and 2024, tariffs have not been the negative death knell for equities that people have said, but you need to be aware of them and mindful of where they might be implemented.
Do you see some areas that seem undervalued in this time?
Yeah, absolutely. And when you take into account that the likely impact of all the things we just talked about is to benefit more mid and small cap companies, and then you add in the fact that value stocks are at historic valuations. So value stocks judged by price to book, they're as cheap as they were during the tech bubble. Dividend stocks are as cheap as they were during the tech bubble. They're way cheaper than the broader markets. But they usually are cheap. So they're about 10 to 20% cheaper on average, and today they're about 30 to 40% cheaper than the overall market. But mid and small cap stocks equally are cheaper than they've been since the tech bubble. Their mid and small cap stocks, judged by the S&P 600 and 400, are trading at about 70% of the PE valuations of the S&P, which is, we haven't seen that since the tech bubble. The difference is, for a 14-year period, about 2002 to 2016, they were more expensive. And so we could see quite a potential either rally or cushion for fall from small cap stocks. So when you put that together, mid and small cap value dividend stocks, that would be getting all three of those historic valuation gaps all in one particular area. And it's no surprise to us, I'm not going to talk about our products, but we do have a small and mid cap fund that's raised quite a lot of money, most of it since July.
Let's talk about artificial intelligence. What's new on this topic, and what's the return on invest with AI?
Absolutely. So we talk quite a lot about artificial intelligence. Just a quick overview, I think with something so new, so big, especially something that had already been in existence and then all of a sudden getting a big hype cycle, you always want to ask yourself two questions. You want to build a framework so that you can kind of walk through the noise and evaluate it appropriately. So number one is, would somebody be looking to invest in or profit from the hype, right? Hire gold miners or sell them pickaxes or shovels. That's a first phase. Then when you really build a framework for AI, you notice that it's about data, using computer power and technological skill to take that data, train them on a model, which spits out an inference, and hopefully we're making that better and better. So when you think about where is the return on investment, this is a great question. Number one, we're seeing phenomenal returns to the cloud computing companies, which makes sense to me because they are effectively the gateway. They're the wholesalers. They're the renters of the NVIDIA chips, right? If you want to use NVIDIA chips, there's really only 7, 10 companies that have almost all of NVIDIA's chips. And it's Amazon, it's Microsoft, it's Google, it's Oracle, it's Dell is putting them in servers. So the cloud computing complex has been one of the best places to access this compute. And you can't forget the data component, right? Because the return on investment for investors is companies like Oracle have beaten Microsoft, which not a lot of people know since the launch of ChatGPT, but it's because of that data. But more to your heart of your question, I think I answered that first from the investor's perspective. Where are investors getting a great return on this AI theme? Let's back it up to the bigger question that a lot of people are throwing at these companies. Where is Amazon, Microsoft, Google, Meta? Where is their ROI on their CapEx spend? And so I just want to break it into two pieces. Number one, they're really coming under criticism for this $350 billion a year that they're planning to spend. First, not all of that is on AI and chips. These are massive research and development, massive CapEx companies year after year after year anyway. So I'd really caution people who are asking the ROI question to Meta and Google and these companies, make sure you're really only evaluating some of that is on the margin for AI. The other thing is, in the near term, meaning 24, 5, and 26, if Meta's CEO and Microsoft CEO, Satya Nadella, and the CEOs of these businesses, if they're not asking the ROI question, then maybe we shouldn't either, and we should just look to profit from that spend in our portfolios.
But maybe you have one more thing, like Steve Jobs, the clean energy. Maybe what's going on there? Why are clean energy stocks performing so poorly?
Yeah, you know, it's actually really interesting. It's a very important thing to know where you're looking. So the simple answer is interest rates and government spending. That's the simple answer. And in terms of the multi-year reason, why under Joe Biden effectively have clean energy stocks not performed that well. And if you look at a number of different indices, it's just a super interesting fact that under Donald Trump's first administration, clean energy stocks did incredibly well. And then under Joe Biden, they didn't. So what does that mean? To be honest, it means that the politicians don't really matter. It means that interest rates are much more important to building a wind farm or a solar farm. The other thing that's really important to be aware, particularly for your European investors, and this is why I said it depends on where you're looking. The invasion of Ukraine from Russia, February 2022, had a huge knock-on effect to clean energy. What ended up happening in March and the Q2 of 2022 is that Europe, led by Germany and the Repower EU, spent a lot of money on any form of energy they can get, solar and a number of other items, such that in Q3 of 2023, these companies started to report their year-over-year sales growth. And any company that had overwhelmingly European sales, like Enphase or SunPower, some of these, they were reporting sales growth down 75%. Whereas First Solar, which sells almost all of its solar panels in the United States, even mostly just in California and Arizona, their sales are continuing to do quite well. So I think it's really important to know where you're looking at with clean energy. And then that takes another step down. That's kind of the front phase, wind, solar. That's what most people think, right, in utility stocks. But if you look at the grid has actually done quite well regardless. So it was up double under Donald Trump. It's up roughly 80-some% under Joe Biden. It just continues to grow because regardless of what's generating the energy, we need to use the energy from our grid much more efficiently. And now we have to power all those data centers that we were just alluding to with the AI craze. And so as we build out these data centers, they're going to be powered by wind, by solar, by natural gas, maybe some nuclear. At the end of the day, the grid is going to come under increasing strain. We're going to add power to the grid, but we need to use it more effectively. And so that's where grid companies in this energy transition have actually performed quite well.
Last not least, are there any unconventional ideas they might be work in the near future?
Yeah, now this is going to go, I just kind of gave myself a little bit of a leeway in that first one. I'm going to go out on a limb and say this massive sell-off we've seen recently in clean energy stocks, meaning since Trump's election, you've seen all the clean energy stocks take another leg down. So I wanted to be clear, they had already been underperforming, and now it looks like investors are hitting the panic button. I think this might actually be setting up a bottoming process for clean energy. So let me be clear, because someone might say, is he saying buy clean energy stocks because of Donald Trump? Maybe. Let's walk this through. First, go look at the returns of the clean energy complex while he was president the first time. That'd be number one. Number two, if it's the worry for government spending, the United States isn't the only country spending money on clean energy, right? It's worldwide. And so second, who's in charge of critiquing the government spending in the United States? As of right now, this whole Department of Governmental Efficiency, this Elon Musk-led group, just want to make sure our investors are thinking, if you had to pick a person to be the face of electric vehicles, batteries, charging stations, solar and storage.
Donald Trump and
Elon Musk, right? So I don't think he's going to be as oppositional as people think. But there are two other areas. Tech, I actually think, is another thing. I think there's some people thinking because the Trump-Vance administration might be critiquing the mega cap tech stocks, that does not mean in any way that the AI revolution is bigger than Trump and Vance and Biden and Harris. And it is an enormous technological revolution such that tech stocks are probably likely to continue. And the third one that I prepared for you, I actually think global industrials are going to do quite well. And the reason for that is I think we're rebuilding our grid, we're rebuilding our defense, we're rebuilding our infrastructure. And let's not forget, when the United States economy does well, it tends to benefit everybody else. And I think one of the periods that might actually shift to a pro-ex-US investment might actually be the next couple of years for quite a lot of reasons. But that's an unconventional response to your answer.
I think it will be an exciting 2025. Thank you, Greg, for your time. Thank you for being here in Berlin.
Thank you. Thank you for your opportunity.